Welcome to the daily update, where I'll go over the action in the market for Friday, February 23rd, and then we'll see how things look for Monday, February 26th. We had another update. We're still looking positive, but when we look under the surface, there is some weakness that we really have to pay attention to. Also, the overhead resistance that I've been trying to point out, actually for the last couple of weeks. I only mentioned it in the weekly videos because that's looking at a weekly chart, but then I've started to I wanted to start showing that in the daily videos because we were getting pretty close to that level. We went right up to that level in Friday's session. We topped out at that point and we backed down from it. Where do we go from here? I'll go through that chart later on, but if we cannot get back above that level and break above that resistance, it's going to present some real problems for the market when you combine that with some weakness that we're seeing. But still, things are positive for right now, and the market continues to set all-time highs. So let's go back and talk about what happened. Right at the open, we did have a gap higher open, and prices hit that resistance. Now, R1 for Friday's session was at 51.08. The overhead resistance that I'm talking about is 51.10 to 51.11, and that's based on a monthly pivot that I show on a weekly chart. And I've got that later on that I'll show you. And we've hit those levels before and then saw some kind of a significant turn after that. Is that what's going to happen now? The table appears to be set for that, but we're not really seeing any confirmation based on price yet with our other charts that we follow. Then as the day went on, prices fell back down to the unchanged level. That's the built-in support level on an up day. And then we chopped sideways in positive territory to close slightly higher on the day. We were up 0.03%, virtually unchanged, but it goes in the books as an up day. Volume did drop to below average. So this is another day when we went up, at least technically, and we saw volume really dropping off. The big move was in Thursday's session, and now you had a lot of people that were reacting to Thursday, at least at the open on Friday, and then things kind of settled down after that. So we are positive still with our technicals. We can't front run this to say, okay, now everything's just going to fall apart. Now, we could make a case for that, but until we see confirmation, that could be a very dangerous thing to do. We're still keeping an eye on inflation and interest rates. This week was pretty much about NVIDIA and how it exploded to the upside and other stocks went along with it. We did see some pullback in those stocks in Friday's session, but we also want to keep an eye on all the geopolitical things that are happening. Some comments. The S&P and the Dow did set new all-time highs, but we did see some weakness in the mega caps, the tech sector, and the semiconductors. And then this will be the last time I show this. I don't know, maybe I'll show it from Monday's video. This is more informational. We don't really deal with the Dow other than just keeping an eye on it, but Amazon will be replacing Walgreens in the Dow. That's only 30 stocks. They're taking Walgreens out. They're going to put Amazon in, and that will be starting on Monday. On a short-term basis, we still have most of our usual suspects here. The Williams percent are the CCI 14 and 20. Those are all extreme positive. The stochastics chart, the standard deviations chart, we're still looking rather extreme there. And the boom indicator still suggesting that we're kind of far away from that 20-period moving average. Intermediate term, we still have the rate of change going back 50 periods. Our Arun indicator really didn't change. We're keeping an eye on our oscillators. They're positive, but they're turning more negative and not really turning back more positive. There's kind of a mixed picture there. The Sean trend meter and the boom indicator based on the 50-period moving average, we're getting kind of far away from that. And then our 10-period new high, new low study for the S&P. And we're still looking extreme with the 150 and 200 period simple moving averages in the long term. We're still dealing with this same scenario that it looks like the Fed is done raising rates. We had a couple of statements this past week where Fed officials came out and pretty much said, yeah, we're kind of starting to entertain the idea of cutting rates. We're just not quite sure when, but it's not going to be right now. The dollar was up and interest rates were down. That did give some support to stocks. We ended up settling at 4.26% for the 10-year yield. And the dollar going up would not support stocks. It was interest rates going down that really gave them some support. We still have the yield curves that we've been following anywhere from a year and a half to 2 years that remain inverted. Sentiment is still extreme. It didn't change. It's above 75. We came in at 78. This is when we start to look at the possibility of using this as a contrarian indicator. And our trend hasn't really changed all that much. We're trying to turn back up with the ADX, but we haven't crossed the moving averages yet. But the green line is still on top. And because of the update, our bias is positive, even though it was minuscule. And our momentum is still positive for right now. So we don't want to go against that, but we do see some things under the surface that are really flashing some warning signs. We didn't have any economic reports on Friday. A couple of charts here. These are U.S. tech stocks crushing the rest of the world. This is how the tech sector has been performing when you compare it to the rest of the world altogether. Something that we probably already knew, but this is just showing, at least with some kind of a graphical representation of how the tech sector is really doing a lot better. And then this is U.S. inflation is much lower in 2024. This is, even though we saw the uptick with CPI and PPI, it's still having a tendency to go down. We have the blue line here, which is the Bank of America forecast. The yellow line here, this is what the Fed is trying to get to. And so it is coming down, and we might be seeing it going back up, but it still has been going down overall. And then this is an interesting chart that was brought up by Chris Schiavocco in his weekly video. And then I went and found this chart on Twitter. It's put out by NDR. When there's this way that we make a statement and we want to make it a blanket statement, a black and white statement, but we can't always do that. That typically when, and you might have already run across this, when the Fed cuts interest rates, that tends to be bad for stocks. Well, the market is waiting for rates to be cut because stocks could, in effect, go higher. What we have to look at is what is the context of why the Fed is cutting rates. There are times, like after 9/11, the Fed cut rates a whole percent, even though the market was closed for a week. Didn't really have much of an impact, but that was something very negative that happened. During the financial crisis back in 2008 into 2009, the Fed was lowering rates because terrible things were happening and stocks were really going down. The COVID plunge, we were up with interest rates when we had all the lockdowns. Interest rates went down to zero. That was another negative thing. But there also have been times when the Fed starts to raise rates, and it's a positive thing for stocks. And what this NDR chart shows is when the Fed is slower, usually when they're acting faster, that means something bad is happening. There's some emergency that the Fed is reacting to. When it's slower, that means, okay, the economy is steaming along and it's not too hot, not too cold. Maybe we can lower interest rates. That will help companies earn more money. That will just be better for the U.S. economy to help it keep going. And when we see slower cycles, this is how stocks perform during that time. And it tends to be pretty positive. And that's kind of what the market is focusing on right now. Now, this could change at any time. We could come in with some kind of situation, something, the bank thing could blow up. There could be a war situation. I mean, you let your imagination run as to what possibly could happen, and that could change this whole scenario. All we can go with is what we're seeing right now. And with this idea that the economy is still humming along, GDP is still positive, at least for right now. We're going to get another read on that in the upcoming week. And so if the Fed does start to cut rates, it's more of a positive environment, and that could give some support to stocks. If something bad does happen and the Fed cuts rates because of that, it could be because we're dealing with a lot of other bad things. So, and that's kind of what this chart is trying to represent here. Here's our intraday chart where we did gap higher and we got up to R1. Now, R1 was at 5108. 5111 is the longer term overhead resistance that we're dealing with. And you look here at the high, that was the high for the day. We couldn't get above that. We tried a couple of times here and could not break above it. We ended up coming back down to the unchanged level and then just chopping more or less sideways, but still ending positive nonetheless. Here's the intraday chart. Not an awful lot of change. We were pretty much flat in the initial overnight session. We did see some strength going into the open that led into the higher open, and then we chopped around and we're trailing off just a little bit as the market closes for the weekend. And this is also one of the warning signs, one of the concerns that we're seeing. We're seeing the red line above the blue line. That means that value is outperforming growth. They were both up slightly, in Friday's session, but we want to see the blue line above the red line, and it's been down below it now for a couple of days after it had been improving. So just a little warning sign there. We're also seeing a little bit of trailing off here with our growth to value ratio for the S&P when we look at the intraday chart. It really shot up in Thursday's session after NVIDIA reported, but it didn't really go up as the market was going up. This was going sideways. We did see an initial open, but then we quickly saw this go negative with the ratio and pretty much end down for the day. Here's the end of day chart. Value was up for the large caps. It was down for the large caps when we look at growth. And the mid caps, it was up, but up less. And the small caps actually saw a little bit more of an improvement when we compare growth to value. And this is another chart we're keeping an eye on. This is small cap growth to value, where it had been falling back, but overall it has been showing some improvement. If this can really get back and start going up, that might help the index to actually break out. But the index really isn't doing all that much right now. We're also seeing an overall uptrend when we look at mid cap growth to value, but we want to watch this. Are we going to see this ratio start to come down, or is it going to begin to come back up, even though the index has been behaving a little bit better? Here's S&P growth to value. It ticked down on an up day. After it did go up in Thursday's session, it ticked down in Friday's session. We're still above the moving averages, and we're just about ready to see a golden cross here. That's positive. If this really starts to fall off, though, that could turn things more negative. And then discretionary to staples, yeah, we ticked up a little bit, but we're not breaking out yet. Another warning sign. We're hitting all-time highs with the S&P and the Dow, and we can't even break previous highs with this ratio. That's a warning sign. Looking at our trend, we are still below the moving average, even though we're turning up with our ADX. That suggests that the trend is still weakening. However, the trend is positive because the green line's on top. However, again, this is above 40, and that's a pretty extreme reading. When the ADX, the red line, or the green line, when any of these lines get above 40, we want to be aware of that because we rarely see those kinds of readings. But at the same time, we saw this back in December, and it lasted for a while. When we're in a solid upward market, we can go extreme positive and stay there for a while. Is that what's going to happen this time? Or the other weakness that we're seeing, is that going to eventually come in and turn this green line back down? And we're seeing pretty much that same thing with the short term. We are turning up, but we haven't crossed the moving average yet. Also suggesting a weakening trend, but it's a positive trend with the green line on top, but the green line is above 40. Then with volume, we dropped off to below average, and that's pretty much what we've been seeing. Again, think about the context. We're now setting all-time highs with 2 days in a row after having a couple of down days. And when we've been seeing up days over the last week, that's when we're seeing volume dropping off. And that's another warning sign. It shows there's not an awful lot of conviction behind this. Looking at sentiment, we really didn't change. We actually ticked up just a little bit with the Ulcer Index. We're coming down with the VIX. We're getting back into that 15 area now with the line chart as well as the bar chart. And with the more positive than negative up day, that's why we saw the VIX decline. We're also seeing a drop off in the volatility of the VIX, where we're dropping below the moving averages with the bar chart as well as the line chart. And we're turning down just a little bit with the MACD. It had been going up, which means the VIX has been slowly rising over time. But with the last couple of up days and the VIX really going down, we're seeing this roll over, but it hasn't crossed below its moving average yet. And the equity put call ratio, I do have an updated chart here. We did decline just a little bit on the daily chart, but when we look at the 5-day simple moving average, we're continuing to go up, which is more negative. And we're still keeping an eye on this. When we look at the VIX to S&P 500 correlation, we're still getting an extreme reading. We've gotten a number of these over the last week or so, and it's like the market hasn't dealt with what it wants to deal with, at least yet. And if you go back and look at the other times that I marked here, that's typically short to intermediate term negative. Now, there are exceptions to that, and we're wondering, is this going to be one of those exceptions? So we have to take this in the context of other charts that we're looking at. We're also looking extreme with Investors Intelligence. That came out a few days ago, and that's good for the whole week. Our advanced decline line, we are breaking out based on price. We're not really breaking out based on volume. So that's another warning sign. We are going back up. We saw a real explosive growth of the new high. So that's turning our 5-period and our 10-period back up. So that internally is showing strength, that you have a number of stocks in the S&P that are making new 52-week highs, many more than are making 52-week lows. We are still positive when we look at the advanced decline ratio. We tick down just a little bit with accumulation distribution, but we are still positive. We tick down again a little bit more with the Chaikin money flow, but this still is remaining positive for now. We're no longer extreme with the Chaikin oscillator after being extreme. And so we're not really breaking out when we look at the advanced decline line studies for the common stock on the NYSE. We are breaking out with the S&P. We're not really breaking out with the mid caps, and we're actually lagging behind with the small caps. Another warning sign here. Here's our chart, and I have another chart to show you here where we're still above this upward sloping trend line and setting new all-time highs. On the bottom, we did drop to below average with volume. And the Williams percent R, even though it declined a little bit, is still extreme positive. We still have the CCI 14 and the CCI 20. Those are still extreme positive. And now when you look just at the S&P, we did go up with our 20, 50, and 200 period moving average studies. And we're still positive with the force index, even though we declined slightly. We're above the midpoint, and the midpoint is turning back up. So when you look at just at the price for the S&P, things are looking really good. It's when we look under the surface that we're seeing some warning signs. We are extreme positive in the short term, intermediate short term, and now long short term for the stochastics. And we came down just a little bit, but we're still in the +3 channel with our standard deviations chart. With our balance of power, we actually declined, but we're still above the midpoint. We're still positive with the go, no go system, and we're positive with the highest high value. We're also switching back more to positive with the TTM squeeze. We're also extreme positive with the boom indicator based on 20 and 50 periods. And then our ease of movement did decline just a little bit after just skyrocketing up in Thursday's session, but it's still positive since it's above zero. The Erin indicator didn't change. It's still giving us an extreme positive reading. We are above zero and advancing with the McClellan oscillator, but longer term, the S&P has been going up. We're seeing a negative divergence here. Now, if this can keep going up, that could negate this negative divergence. But for right now, we have to go with what we're seeing. So we're trying to turn back up based on price. And even with the summation index, we had been going up, but this has been going down, both based on price and volume. But when we look at the day-to-day change, we are turning back up at the summation index based on volume. But longer term, there is that negative divergence. And we're also above zero and advancing with the NYSE McClellan oscillator. Also a longer negative divergence when we compare it to the S&P. But we're turning back up with the summation index based on price and volume. So we're hanging in there for right now. We actually turned down a little bit with the Swenlin trading oscillator based on price and volume, but we're still above zero. And this is where we're getting some kind of mixed signals here. The PMO is trying to go back up, but it's already extreme positive, and it's giving us a longer-term negative divergence. We're starting to go positive based on price, but we're still flat when we look at the moving average when we study volume. We did see a little bit of improvement with the PMOs that are rising. The buy signals are going up, and we're starting to turn back up with the PMOs that are above zero, and that's positive. And we continue to be positive with the Elder's Impulse system for the S&P. The parabolic SAR continues to be positive, and to me, that's kind of a big deal. That's way more in the positive camp. It turned positive after Thursday, and it continues to be positive. The slope oscillator's trying to turn back up. It has not crossed above its moving average, and it's already in an extreme positive condition. The MACD is trying to come back above its moving average, and you could make a case for a longer-term negative divergence. So we look at all of our oscillators. We're trying to turn up, but extreme with the slope and the TSI. We're turning back up with the MACD, the PMO, and the PPO, but you could also make a case for longer-term negative divergences here. But when we look at the long term, we are still declining with the TRIX and the KST, even though they're showing a little bit of an improvement here. We're still above all the plotted moving averages in our moving average tree. So that is still looking quite positive. And we're also seeing a negative divergence with the bullish percent index. It has been going down as the S&P has been going up. And we did go up with the bullish percent index, but it's not really showing us an awful lot of strength currently. We ticked back up a little bit with the NYSE bullish percent index. We actually ticked down with the NASDAQ 100 bullish percent index after it's dropped below 70. We actually declined a little bit with the money flow index. The ultimate oscillator continues to be positive. The vortex is rolling over, but the green line is still on top. That's positive. And I kind of explained this yesterday. I'm trying to change the way I show the RSI chart. Back here earlier in 2023, we saw most of the readings for the RSI above 50, and that's when we were going up. When we ran into some trouble in the mid to late summer and then into the fall, most of the RSI readings were below 50. We're still in a situation now with the 14 period and the 9 where this is going up and we're seeing most of the readings above 50. So that is still positive. And we're not extreme yet with either one of these. We are looking more positive with the on-balance volume. We're just barely extreme positive with the rate of change going back 50 periods. This is a new chart. This is supposed to go in conjunction with the 50 and 200 period moving average study. I've been watching this for a while, but I decided to go ahead and include this. This is also on a short-term basis showing some negative divergences here. We were really showing a lot of strength as the S&P was going up, but then it kept going up, but we saw a lot of stocks above their 20-day moving average start to go down. Now we are seeing some improvement here. And if this can come back and show follow through strength, it could negate this negative divergence that we're seeing. So we want to keep an eye on this. Here's our 200-day moving average study showing some improvement, but still longer term negative divergence. And we're seeing that same thing with the 50-period moving average study. The copy curve is turning back up, but is still negative. The Sean trend meter is extreme positive. And I want to include this because we're really, really close to that all-time high with the NASDAQ, but we're not quite there yet. That would help confirm the all-time highs that we're setting in the S&P and the Dow, and it would really help it a lot, but we're not quite there at this point. So until we actually close above this, we want to treat this for the NASDAQ as possible overhead resistance. Looking at our charts, when we look at the trend, we're positive with the Heiken Ashi. The Kegi chart is positive. The Renko is positive. The 3-line break is positive. And we had another new X drawn in. We had one after Thursday. Another one, we went up just enough to draw in a new X in a point and figure chart. So when you just look at price of the S&P, everything looks really, really good. It's when you look under the surface, you start to see some concerns. Here's another one that looks good. We're above this trend line. We had lost it earlier in the week, but then Thursday we gapped up above that, and we continue to be above this trend line. Now, if weakness does start to come in, we're going to be watching this line to see if this offers some kind of support. This is the big one for right now, and I've been pointing this out for the last couple of weeks and in the weekly videos mostly, and then in the daily videos over the last couple of days. If you go back to 2021, and we were coming up to the end of the year and we hit this pivot point, which is a monthly pivot point. And then we spent 2022 just not doing very well for the market. That was a monthly pivot point that we hit. Then we started a rebound. And then last summer, July 31st of 2023, we came back up and we hit this pivot point that was recalculated now. And then we spent the next couple of months going down. We've been going up. We hit this in Friday's session, this R1 level right here. That was the high for the session. Do you think the market knows this? Yes, they do. And the cool thing about these pivot points is you can see there are pivot points for the next month already on here. These are lines that you can see before they even happen. And so this can help you to be prepared to look for these things. Other times we just blow through these pivot points and it really doesn't mean anything. But there are also times when it means something. And given the fact that we're overbought, given the fact that we're seeing overhead weakness or a lot of across the board weakness in the S&P, this is probably going to be on the positive side, difficult to break through. On the negative side, this could end up providing overhead resistance before we see either a decline or some kind of a significant pullback. Now, I don't know what's going to happen, but we want to be ready for both. We can't just take one scenario and run with it. We have to plan for this and know that these things are happening. All right, we are still extreme positive with the 150 and 200 moving average study. And then we're still positive when we look at the Keller market model across all the different indexes. Here are the alerts that were triggered in Friday's session. They were almost all blue or green, except we did get below 16,000 there for a while with the NASDAQ. But this is pretty positive. And even Canada set another new all-time high. This is a new chart. This was also brought out by Chris Shavako's weekly video. I've been watching this chart for a long time, but I want to bring out what it's saying because it kind of contradicts some other things that I've been saying and that what you're hearing a lot of. There's a small number of stocks that are responsible for all of the growth in the indexes. And that's true, especially when you look at the NASDAQ 100 and the S&P 500, which is what we follow. But when you look at this chart, it's telling a different story. This is the total U.S. stock ETF. These are all the stocks in the U.S. And we're breaking out above previous highs and setting new all-time highs. You can't there's 2,651 of these. You just can't take 7 and make that account for everything. So there is some across the board strength that is happening. It may be not all inside the S&P. It may not be in the NASDAQ 100, but this also kind of goes against that idea that there's just a handful of stocks that are responsible for everything. No, they're responsible for a lot, if not most. But we wouldn't be seeing this setting new all-time highs if that wasn't the case, that a lot of stocks are participating. Looking at the equal weight, it's pretty much even now with the S&P 500 weighted index. We came back up. I'm sorry, we declined just a little bit here with the ratio, because we saw a little bit of pullback in the mega caps. The Dow, even though this is a scary looking bar too, we opened, we went up to the high, and we closed down right about where we opened near the low for the day. But it was still up, so we still set an all-time high for the Dow. But this bar in and of itself is not all that positive looking. But we still remain positive with the Elders Impulse System for the diamonds. Also, another kind of scary looking bar for the NASDAQ. We did go up, and then we closed near the low for the day, even though we actually ended up being down slightly for the NASDAQ. The NASDAQ 100, I'm sorry, okay, back up. This is the NASDAQ. We are getting close to that all-time high, but we're not quite there yet. This is the NASDAQ 100, also closed well off of the high. Is that a warning sign in and of itself? But we're still positive with the QQQs. We're looking at the Elders Impulse System. We're still negative, but improving when we look at the momentum of the NASDAQ 100. The small caps, they were up 0.3%, but not really breaking out. On the positive side, they're still above their 50-day moving average. And we haven't switched. We were negative, and now the last 2 days, we switched over to neutral for the small caps when looking at the Elders Impulse System. This is the Russell 2000 small cap ETF. We're still above the support level, so that's positive, and we're still above the 50-day moving average. The RSI is still above 50. We haven't quite crossed yet with the momentum, and longer term, we're still in an uptrend. So there's some positive things to take away from this. We just need to see some follow through with the index itself. The mid caps were up a little bit, and they're still above this pivot point, and they continue to be positive with the Elders Impulse System. And the FANG index, it ended up being down slightly after setting a new all-time high. The financial sector was up and is still in an uptrend. So we look at New York Community Bank, which was up, or no, it was down a little bit more than 2%. And the dollar ended up being down slightly, but we're still above both of these lines. The longer we stay up here, the more we might see a golden cross. A strengthening dollar is typically weak for stocks. Looking at the 10-year yield, where we did drop off. Really didn't move much in Thursday's session, but we came down in Friday's session. So we went up based on price for the 10-year. And then looking at growth to value, a little bit of an improvement between the Qs and S&P. We actually turned down with discretionary to S&P. We've been dancing more along the moving average, but for the most part, the moving average has been going down. We saw a little bit of an improvement with large cap growth versus large cap value. So with the large caps, mid caps, and small caps, not any real strong showing here, but they're still holding up for right now. We're still positive with the 5-period moving average when we look at the Amex, NASDAQ, and NYSE of the highs minus the lows. We're still extreme with our 10-day average of the S&P 500 highs minus the lows. So what's our outlook for Monday? We are still positive, but we are showing quite a bit of overbought or extreme positive indications, which may not always be negative. We can stay overbought if the market's in a really positive situation. But we're dealing with this overhead resistance. If we can get above that 5110 to 5111 area and then close above it, that would be significant overhead resistance if the market even gets back to that level. We're still seeing some potential areas of weakness, and we're still dealing with a period of weak seasonality. We're going to get new home sales on Monday, and then just keeping an eye on the geopolitical things that are happening. Here's the economic calendar for the upcoming week. We are going to get GDP, the second reading. That may not be a big deal unless the number is really big. It's really different from the first time that we had this. If it comes in about the same, it will pretty much be a non-event. We're going to get the other really big inflation report with PCE prices on Thursday. We're going to get ISM manufacturing and consumer sentiment on Friday. Seasonality, we're neutral to positive with the Dow and S&P. We're neutral to negative with the NASDAQ 100. So a little bit of tilt in the favor of being positive that way. But we are also coming into this weaker time. Now, we're going to be on the 26th, where sometimes we see a little bit of a bounce here, but then we see some more weakness going into the latter part of the month. This gives you a bigger context of how it acts during the whole year. We're also wondering where we're at here with the Stock Traders Almanac. We do see a bit of a turn down as we enter the latter parts of February. We also see some weakness in February and into March when the sitting president is running for re-election. The month of February is still the worst of the best 6 months. Monday's session, though, tends to be the most positive day of the week compared to how we did in 2023. But it's still up 67.3% of the time. That still means that it's down, what is that, 33% of the time? Okay, so yeah, I mean, it is more positive than negative, but there's still some negative things that can happen. We will be on the 17th trading day of the month, where during an election year, we see a little bit of negativity here. And then for the rest of the month, according to Tom Bowley's research, we are negative. So our scenarios, can't really go with the down one. We might be seeing all kinds of crazy things that are turning negative, but we're not seeing any confirmation yet with our charts. And we're a little apprehensive to go with the positive scenario. What I'll be watching for is if we get back to that 5110, 5111 area and then close above it, that's going to turn things quite a bit more positive. If we can't do that, we might be destined to chop sideways to even see a decline from there. And we're still going against the sideways idea because even though the ADX is below its moving average, it's still above 20, suggesting that we are in a trending environment. So this is another day when we saw volume fall off when we've had an up day. The risk on posture just has not been helping us. The equity put call ratio based on 5 periods, that's going up, which is negative. We're keeping an eye on our different oscillators. Yeah, they're extreme, and that's positive, but they're below their moving averages. They're trying to turn up, but they haven't really switched over to positive yet. But if they do switch over and go positive, how much further can they go? So that's another thing to be aware of. We're also watching those negative divergences that we're seeing. Please keep in mind that some of that is due with how these indicators are calculated, since they are moving average based. We're still seeing negative divergences when we look at the McClellan oscillators and the summation indexes. The Copic curve is negative, even though it's improving. The NASDAQ 100 bullish percent index is still below 50 and it declined. And the momentum for the NASDAQ 100 is still negative, but showing some improvement. We're still seeing a negative divergence with the small and mid caps when you compare them to the S&P. Discretionary is not really performing all that well when you compare it to the S&P. And the transports are not performing all that well when you compare it to the Dow and the S&P. And we are in a period of weak historical seasonality. Positive signs. For right now, growth is hanging in there, not really breaking out, but it's not falling apart yet either. The parabolic SAR, this is a big one to me. This has switched back positive. Our oscillators are extreme positive for right now. The vortex is positive. Small and mid cap growth is still holding up for right now, but it's not really performing with any real strength. The financial sector is positive. So our conclusion, we're positive. We still have a lot of overbought or extreme positive indications. To me, this overhead resistance is a big one. Now, we may not even get back to that level. Maybe Friday is the last we're going to see it for a period of time. But if we do go back and test that, that's the level in Monday's session that I'm going to be watching. We are seeing some potential weakness developing, and we are in a period of weak seasonality. So in the short term, that's pretty much what we're watching. In the intermediate term, we're going to be watching because that's going to affect the intermediate term if we don't break above that overhead resistance. In the long term, yeah, that might have an impact, but right now we're still overbought with our 150 and 200-day moving averages. Thank you. I really hope you found this helpful. I will be preparing the weekly video, the intermarket analysis video, the deep dive video. I'll see what I put together. I may be putting a what to follow video out. Probably that'll be after I do the deep dive video. So I hope you have a great weekend, and I will talk to you in the next video.